Continental Resources is a petroleum liquids producer in the United States, listed on the New York Stock Exchange. The company was founded in 1967, and its growth strategy has focused on crude oil since the 1980s. Now, with a focus on the exploration and production of oil, Continental is on a mission to unlock the technology and resources vital to American energy independence. We are going to focus on the impact of a decrease in oil prices on products and services, operations, and decisions. We are also going to look at the influence of the rate of production and share price on forecasting the oil prices at the end of quarter 4. We think that the rate of production and share price are good variables to take into account when predicting how future oil prices will affect Continental Resources. Both of these variables will be heavily affected by oil prices. Currently, oil accounts for the majority of Continental Resources production. They have emphasized the need to cut costs and prevent taking on debt. In order to cut costs, they are trying to close the gap between capital spending and cash flow, limiting the need to increase borrowings. With the decrease in oil prices, Continental Resources plan to cut back on the number of oil rigs in use for hydraulic fracturing. The company is therefore planning to reduce the number of oil rigs from 50 to 31 in 2015. While Continental Resources still expects to increase oil production, the rate at which it increases oil production is likely to slow down. The graph shows that the Bakken Formation is still one of Continental Resources' main areas for hydraulic fracturing. The Bakken Formation is responsible for a considerably large proportion of oil production in the U.S. They will most likely continue drilling in that area instead of investing in new areas.
Obviously, it is not a good period for our company. The common belief that shale operators may be able to weather lower prices has been disproven. The strategy was to cut on costs by using new techniques. However, American shale production for many producers like us exceeds current market prices, especially for new oil wells that are quite expensive to drill and complete. In addition, the company decided to scrap its oil hedges. With no protections against falling oil prices, the company needed to adjust its spending in order to avoid going into debt.
Continental Resources have already announced a significant reduction in its new production development and capital expenditures budget for 2015, with a $2.7 billion target, nearly 50% less than the original $5.2 billion initial estimates. The company will only average around 31 drilling rigs in operation over the full year, a major cut from the 50 currently in operation. Plain and simple, one of the fastest growing producers of the past 5 years is finally taking its foot off the gas.
Continental Resources is expected to cut its capital expenditures by 41% in 2015, the lowest of the Bakken Formation. Continental Resources is facing the toughest challenge since the Great Recession. These operations should ensure the company's survival if the oil market stays depressed for a long period of time.
So now we're going to look at a few scenarios regarding changes in oil prices. On the high end, where oil prices go above $50, forecasts were undervalued and the return on equity is high. Share prices for Continental Resources will increase. Continental Resources should increase the rate of production and slowly increase the number of oil rigs in use back to their original count of 50. If oil prices break even at $50, Continental Resources should continue to produce at the same rate of production and maintain the number of oil rigs in use. On the low end, if oil prices decrease further and forecast estimates were overvalued, Continental Resources should decrease the rate of production and continue to reduce the number of oil rigs in use.
Before going into the forecast, it's worth mentioning that price can change faster than the fundamentals of supply and demand. Many different factors play key roles in determining the oil price: China's economy, American shale, elasticity of demand, OPEC operations, and geopolitical flashpoints. Therefore, predicting oil prices is a complex task, and we decided to combine different approaches to come up with a sensible range. First of all, we performed some analysis using the tool R. Looking at the weekly prices of the past 2 years, we produced a linear regression showing a downward sloping trend. Then we found a mathematical function by using the intercept and the slope, and calculated the potential values for 31st December 2015 and 31st December 2016. However, we immediately noticed that this kind of data cannot be fitted linearly, but it can still be taken into consideration when making the final range estimate, because it takes into account the historical data.
To further make our oil price estimate more reliable, we decided to contact some experts for their opinion. We contacted Helge Lund, former CEO of Statoil and now the CEO of BG, and Torbjørn Kjus, who is the chief oil analyst in DNB markets, asking for their personal opinions. Helge Lund replied, I believe the oil price will become slightly higher towards the end of this year and that it will be pressured in that direction even more throughout 2016. Over time, the price will go towards the marginal cost for production of oil. If it is 70, 80, or 90 US dollars per barrel is hard to say, but I believe there will be a pressure on the price to go upwards. Torbjørn Kjus replied, now the prices have dropped so much that it is hardly sustainable for the oil industry, since the current prices lead to massive cuts in investment globally. And that he and his team in the DNB markets are one of the most optimistic with their view on oil price that indicates $65 per barrel in 2015 and $80 per barrel in 2016.
The U.S. Energy Information Administration expects higher uncertainty for 2015 than in previous years. Oil prices are estimated to be around $32 on the lower end and $108 on the higher end. The volatility has increased by 33% from 2014 up to 52%. Taking into account price volatility, the oil prices are expected to be around $66 by December 2015.
Finally, we consider the possible scenarios for supply and demand, bearing in mind the data previously found with VAR and the expert opinions. For December 2015, we found a first potential scenario. The fall in demand experienced so far causes trauma to many global producers that default on loans with knock-on to banking sector and the broader economy, resulting in further falls in demand during 2015. So, the potential estimate is between 40 and 50 US dollars. The low oil price in 2015 plays an important role in the global economy that rebounds strongly in 2016, pushing demand up to 2 million barrels per day. Rising demand collides with falling capacity, sending the oil price back to $70 per barrel by December 2016, so the average is between $60 and $70. In the second scenario, we found that supply capacity could grow and then fall back to where it is today. The price ends up at around $60 per barrel, recovering a bit from where it is today, but in the interim may go on an excursion to lower prices, followed by recovery, so they average it between $60 and $70. In the second scenario, for December 2016, we found that the price of 2015 gives the oil industry a hangover and supply drops 1 million barrels per day. At the same time, consumers party and falling supply collides with rising demand, sending the oil price back up to $90–$100 per barrel by December 2016.
To make our oil price estimate more reliable, we decided to contact some experts for their opinion. I sent an email to Helge Lund and Torbjørn Kjus, asking for their personal opinions. Helge Lund replied, I believe the oil price will become slightly higher towards the end of this year and that it will be pressured in that direction even more throughout 2016. Over time, the price will go towards the marginal cost for production of oil. If it is 70, 80, or $90 per barrel is hard to say, but I believe that there will be a pressure on the price to go upwards. Torbjørn Kjus replied, now the prices have dropped so much that it is hardly sustainable for the oil industry, since the current prices lead to a massive cut in investment globally. He continued to explain that he and his team in the DNB markets are among the most optimistic with their view on oil price that indicates $65 per barrel in 2015 and $80 per barrel in 2016.
Obviously, not all the scenarios are equally likely. All things considered, we agreed that the information from the regression formula can be weighted for 10%, the average expert opinion for 50%, and the demand-supply graphs considering different scenarios and historical data for 40%, 20% each scenario. Therefore, for the 31st of December 2015, we found the average price of oil at around $57, and for the next year, at around $71. As we can infer from the graph taken from the DNB market report with a standard error of 20%, we can define our range for December 2015 between $46 and $69, and for 31st of December 2016 between $57 and $86.
To estimate how the variable production rate will change over the next 2 years, we chose to look at how Continental Resources did during the financial crisis in 2008 until 2011. As we can see from this graph, Continental Resources managed to keep a positive production rate, albeit low. We have to remember, however, that the financial crisis might affect an oil company in a different way than the more direct drop in oil prices will. This shows Continental Resources' production rate compared to the average U.S. oil company production rate in the time period 2008-2013. Continental Resources clearly did better than average when it came to production growth during the financial crisis. They also seemed to recover rapidly after 2010, when the growth increased more rapidly than during the crisis. According to Harold Hamm, the CEO of Continental Resources, the company will increase its oil and gas production by 20% in 2015. This production rate seems quite optimistic and might be biased, considering the CEO of Continental Resources probably want the shareholders of the company to hold their shares. As our expert opinion from Helgelund stated, the production of shale oil is very expensive. Because of this, when the price is as low as it is today, the companies who produce shale oil will struggle with keeping up the supply. This will affect the production rate of Continental Resources, then the share price, and all.
To see how the oil price affects Continental Resources, we decided to take a look at the share price of Continental Resources and the oil price developed over 7 years, and if there was any significant correlation. Continental Resources share price seemed to follow the same trend as crude oil in the last 7 years. During the financial crisis, when the Brent crude oil price decreased from $140 to $43 in only 7 months, Continental Resources share price dropped to $9 from $34. After that, the oil price had an ascending trend, which Continental Resources also followed. In July 2014, when the oil price started to decrease, crude oil was 112 and reached 52 in 7 months. In February 2015, Continental Resources share price also decreased in that period, reaching $44. As we can see in the graph, the majority considers Continental Resources stocks worth holding, while others consider it worth buying. However, in the last 3 months, there has been a slight increase in the number of people that consider it better to sell. Experts say that Continental Resources' very impressive revenue growth greatly exceeded the industry average of 11.8%, when appeared to have helped boost the earnings per share. The company has demonstrated a pattern of positive earnings per share growth over the last 2 years. We feel that this trend should continue, suggesting that the performance of the business is improving. During the past fiscal year, Continental Resources has increased its bottom line by earning 2.07 versus 2.03 in the previous year. This year, the market expects an improvement of 2.78 versus 2.707. After analyzing the historical share price of Continental Resources in the last 7 years, we used R to produce a linear regression. Continental Resources seem to have an upward trend. We found a function using the intercept and the slope, a straight line equation, and calculated the potential values for the 21st of December 2015 and December 2016. We found that by the end of 2015, CLR's share price will range between $70 and $75, and by the end of 2016 it will be between $79 and $85. This is also confirmed by the expert opinion and considers that the positive earnings per share will continue. However, the production rate of Continental Resources will be affected by the oil price, and the share price will therefore follow the decrease in production. Although the linear regression shows an upward trend for the stock price, it doesn't take into account the oil price. Based on the regression and how the share price behaved during the financial crisis, we can expect the share price to grow as long as the oil price is in the range we have estimated. Based on this, as well as the production rate estimate, the share price will not follow the trend R predicted. Basing our estimates on all these factors, we believe that the share price will be in the range of $40 and $50.
Taking everything into consideration, oil prices will be one of the major factors affecting Continental Resources in terms of areas of operations and capital expenditure. Oil prices are predicted to slightly increase in 2015 and increase even more in 2016.